Okay, so let's continue with the depreciation of non-current asset. Depreciation is specifically for tangible asset, for example, building, motor vehicle, equipment, machinery, furniture, fixtures, and fitting. All right. And what is a depreciation? Okay, so depreciation is an allocation of cost of an asset or depreciable amount of an asset over its estimated useful life. All right. So when we purchase the asset, we have an estimation of how long we are going to use the asset. All right. So throughout this period, we are going to provide a depreciation. Okay, a depreciation for this asset. Okay, over a depreciation is an allocation of cost, meaning that you are going to take the cost, okay, divide by the estimated useful life. So that is the amount of depreciation, and that amount, okay, will be added to the accumulated depreciation. And what happened at the end of the year? Okay, when you report the carrying amount or carrying value or net book value of asset, okay, at the end of the year, okay, you are going to see a reduction in the value of asset. All right. Okay, it can be an allocation of cost. It can be an allocation of depreciable amount if, okay, your asset has a salvage value or scrap value or residual value. Okay, meaning that at the end of its useful life, okay, your asset still have some value attached to it. All right, or you can sell as a scrap. Okay, all right. So what are the causes of depreciation? Why do we need to provide for depreciation? Okay, why we want to recognize a reduction in the value of asset? Okay, because we use the asset, and because of the daily usage of the asset, and of course it can cause wear and tear to the asset. All right, and because of maybe obsolescence, all right, due to technological advancement. Okay, in the market we have a newer asset, we have a better asset, better machine, okay, better equipment. So what happened to the existing asset that we already acquired in the past? All right, so of course there will be a reduction in the value. Okay, so we want to recognize all of these causes. Okay, all right, and then due to environmental factors, okay, due to natural factors. All right, okay, due to for example, weather. Okay, it depends on the weather where your asset was located. Okay, all right, and then due to expiration of contract. Okay, expiration of contract. Okay, as you are approaching toward the end of the contract, okay, usually there will be a reduction in the value of asset. Let's say, for example, for leasehold land, for example, okay, for leasehold land, even though we did not provide depreciation for a leasehold land, or maybe the building on a leasehold land, for example, okay, towards the end of the leasehold term, okay, usually the value would be lower because at the end of the term, okay, if you want to renew, then you have to pay a huge amount of premium. Okay, so we want to recognize all of this situation. Okay, all right, so in accounting, what are the reasons that we provide for depreciation? Okay, number one is because of to recognize the usage again, yeah, to recognize the usage of non-current asset. And then due to the matching concept, okay, because we use the asset to generate the revenue or income to the business. Okay, so in that process, okay, we are using the asset. So we want to recognize, okay, the cost of using the asset, okay, in generating the income, okay, for the business. All right, and then we want to make sure that, okay, we want to avoid reporting overstated asset in statement of financial position. So we come up with our own estimation. All right, okay, so overstated, we want to avoid reporting overstated because of the causes, okay, of the reduction in the carrying amount of asset that we discussed just now. Okay, wear and tear, obsolescence, environmental factors, expiration of contract. Okay, and there could be other causes as well. Okay, so we want to make sure that when we report in the statement of financial position, okay, we try our best, okay, to report it as accurately as possible. Okay, and depreciation also will reduce the profit, hence reduce the amount of profit distributed to the owner. Okay, therefore the funds, all right, instead of distributed to the owner, can be retained in the business. Okay, if it is if the owner take the money, okay, from the profit distribution, all right, if the owner take the money from the profit distribution, okay, due to depreciation provided, so we can save money, all right, for other strategic planning of the business. Okay, all right, so the factors that we need to consider when we provide for depreciations are cost of non-current asset, the useful life of non-current asset, and if there is any scrap value, residual value, or salvage value. Okay, so how do we want to provide this amount of depreciation, okay, in the statement of profit or loss, and then added to the accumulated depreciation, okay, in the statement of financial position. All right, so there are two methods to calculate depreciation. So the first method is called straight line method, all right, and the other one is reducing balance method. However, there are many other methods of depreciation, but for ACC 106, we limit to these two methods only, straight line method and reducing balance method. All right, for straight line method, the formula is cost minus scrap value or salvage value or residual value divided by the estimated useful life of the asset. All right, or cost minus scrap value, okay, times the percentage, the estimation by the business. All right, so but for reducing balance method, the formula is different. Okay, the depreciation is equal to, okay, the rate of depreciation, okay, in percentage, okay, times the carrying value. So what is a carrying value? Carrying value is equal to cost minus accumulated depreciation. So what is the main difference between straight line method and reducing balance method? Okay, if you refer to the formula for straight line method, okay, the cost minus scrap value or depreciable amount divided by useful life, meaning that every year you are going to deduct the same amount of asset. While for reducing balance method, okay, when you calculate, all right, you calculate on the carrying value. Okay, it depends on the carrying value at the end, at the beginning of the year. All right, because we calculate based on the carrying value at the end of the year. Okay, to find out the carrying value at the end of the year. Okay, so this carrying value, okay, is where you deduct cost. Okay, sorry, carrying value is equal to cost minus accumulated depreciation. So accumulated depreciation meaning that this is the amount of depreciation starting from year 1 or starting from the date you purchase the asset. So you add. Okay, every year you are going to add the amount of depreciation to the accumulated depreciation, meaning that the amount of accumulated depreciation will be different from one year to another and it is increasing. So what happened to the carrying value? Carrying value will decrease from one year to another, and hence the depreciation also will be reducing. Okay, reducing. Okay, so that's why the name is reducing balance method. Okay, and the depreciation can be computed on monthly basis or yearly basis depending on the business policy. Alright, so yearly basis meaning that regardless of when you purchase the asset, when you acquire the asset, okay, when you get the asset, alright. So regardless of that, we are going to calculate the depreciation, okay, as if we purchase starting from first day, okay, of the accounting period. Okay, unlike monthly basis, okay, monthly basis will take into account, okay, when did you purchase the asset? Is it in the month of January, or is it in the month of October? Then you are going to apportion the amount of depreciation per annum. Okay, you are going to apportion that amount accordingly. All right. Okay, so for example, let's say for example, a company purchase, okay, a business, okay, acquired an asset on 1st July 2020. So at the end of year 2020, which is on the, let's say for example, assuming that the business closes their account on 31st December every year. Okay, so we're going to calculate depreciation on 31st December 2020. Alright, if the company adopts yearly basis, okay, the amount of depreciation, assuming, okay, they are using a straight line method. Alright, so let's assume the cost is 10,000. Okay, and this asset is to be used for 10 years. Alright, so every year they are going to provide 1,000 depreciation. Okay, if we are using yearly basis, regardless when did you purchase the asset, is it on 1st July, is it on 1st April? Okay, so we are going to provide depreciation for 1 whole year. Okay, but if the business adopts monthly basis, okay, the amount depreciation, okay, using the same example, so 10,000 divided by 10 years, all right, multiply with 6/12. Okay, so the amount of depreciation is 500,000. So you have to take into account, okay, you have to calculate, okay, how long, okay, have we used the asset, okay, in the business for that year. All right, so since 1st July, okay, starting 1st July to 31st December, it equals to 6 months. Okay, July, August, September, October, November, December. So 6/12 because we divide by 10 years. All right, so the amount that we calculate, okay, 1,000 is for 1 year. So if you are using monthly basis, then you have to apportion that amount, okay, depending on the number of month. Okay, all right, so what is the accounting treatment for depreciation? The accounting treatment for depreciation is where you debit depreciation account, meaning that every year after you adjust or calculate for depreciation, then you are going to create a depreciation account. Okay, you're going to create a depreciation account, okay, called depreciation. Okay, and then the amount of depreciation that you have calculated then will be transferred to, okay, or credited to accumulated depreciation. Okay, let's say for example, using the same example, so debit depreciation 1,000. Okay, I'm using examples of yearly basis just now, where we calculate the depreciation, and the depreciation is equal to 1,000. Okay, so how to generalize the transaction? Debit depreciation 1,000, credit accumulated depreciation. Okay, so accumulated depreciation is opposite to asset account. So if increase in asset account, you debit. So increase in accumulated depreciation account, you credit, meaning that now we are adding to accumulated depreciation account. Okay, so the depreciation 1,000, and then at the end of the year, okay, we are going to transfer this amount to statement of profit or loss. Okay, 1,000, and then we credit depreciation. Depreciation is a temporary account. Okay, but the accumulated depreciation is a permanent account. Okay, all right, so meaning that at the end of the year, we are going to close, okay, this depreciation account. Okay, and then you have to show it separately, okay, for different types of asset. You have to show depreciation for if you have a building, if you have motor vehicle, if you have office equipment, if you have fixtures and fitting. Okay, so show them separately. Okay, so it will be easier for the lecturer to identify you are computing for which type of asset. Okay, all right. Okay, and then sometimes, all right, sometimes the term that they use, okay, for the depreciation, for the policy on the depreciation, sometimes they would state as, okay, to calculate depreciation on cost. Okay, for straight line method. Okay, this one, they are going to use the term to calculate depreciation on carrying value. All right. Okay, so if they state that to calculate on cost, that means they are using straight line method. If it is on carrying value, they are using reducing balance method. Okay, so now let's look at one example. All right, so one example here. So let's look at together. Okay, so we have here Encik Alim, who operates a grocery shop known as Kedai Runcit Alim. So given below is the extract of the business trial balance as at 31st December 2019. All right, so Encik Alim, okay, Encik Alim, sorry, not Encik Alim, Kedai Runcit Alim. Okay, Kedai Runcit Alim, okay, has motor vehicle worth 12,000, fixtures and fitting 15,000, machinery 120,000. All right, and then as at 1st January 2019, meaning at the beginning of the year, okay, the accumulated depreciation, okay, this is the amount of depreciation accumulated since the day one that they purchased this motor, since first year, okay, they acquire this asset. All right, so motor vehicle, the accumulated depreciation is 4,000, fixtures and fitting 7,400, okay, machinery is 32,000. All right, So the depreciation is to be provided on yearly basis. So regardless of when they purchase the asset, okay. So the depreciation is, okay, for motor vehicle is to be provided at 10% per annum on the carrying value. Fixtures and fitting 5% per annum on cost. Machinery 10% per annum on cost. Okay, so you're required to calculate the depreciation for motor vehicle, fixtures and fittings, and machinery. And then to prepare the journal entry for depreciation calculated above, and then to prepare an extract of SOPL and SOFP, statement of profit or loss, and statement of financial position. Alright, so the solution is, okay, so the first requirement is where for you to calculate the depreciation. Okay, so depends on the business. Alright, depends on the business policy. Okay, so the motor vehicle is 10% on the carrying value. Okay, so 10% on carrying value, meaning that, okay, the cost minus the accumulated depreciation. So 12,000 minus 4,000 times 10%. All right, and then for fixtures and fitting, okay, okay, on cost. All right, so this is cost 15,000. Machinery also on cost 120,000. Okay, so fixtures and fitting, the rate of depreciation is 5% per annum, whereas for machinery it is 10% per annum. Okay, so 5% times 15,000, 750. 10% times 120,000 is 12,000. Okay. All right, so how to record, how to journalize the transaction, how to prepare the adjusting entry for depreciation. So debit depreciation of motor vehicle 800, credit to accumulated depreciation of motor vehicle 800. Okay, and a debit depreciation, fixtures and fitting 750, credit accumulated depreciation, okay, same amount 750. Debit depreciation for machinery 12,000, credit accumulated depreciation of machinery 12,000. Okay, so depreciation account here is a new account, okay, created for that period only, whereas the accumulated depreciation is a permanent account, okay, where you have opening balance. All right, and then you're going to add this amount, okay, to the existing account, and at the end of the year you will have a new amount. Okay, so I'm going to show you only one example, okay, for motor vehicle. All right, some of you may need to see, okay, how it affects the accumulated depreciation account. All right, so this is an example. Okay, because accumulated depreciation is opposite to asset account, so this accumulated depreciation will have a credit balance. Okay, so balance BD. Balance BD is referring to the opening balance. So what is the opening balance for motor vehicle? For the accumulated depreciation of motor vehicle, okay, 4,000. All right, so 4,000. Okay, so when we prepare the adjusting entry and we said that to credit accumulated depreciation, meaning that we are going to add to this 4,000 here. All right, so we're going to write it here as depreciation, okay, of 800. Okay, that's it. All right, so at the end of the year, what happened? Okay, so you're going to close this account. You're going to balance off accumulated depreciation account. Okay, so the total is 4,800. That's it. And this will become the balance BD, okay, for the following year. All right. Okay. So how to show all of this in extract of SOPL and also SOFP. Okay. So depreciation. Okay, depreciation is an expense. Okay, so we are going to put that under expenses. Okay, in the statement of profit or loss. Okay, so this is how you show the depreciation. Okay, or you may write the amount. You may write the details. Okay, separately. Okay, depreciation motor vehicle, depreciation fixtures and fitting. Okay, there is no right or wrong answer for that. For how you want to write the depreciation, how you want to show, as long as we can see that it is a depreciation. Okay. All right. So depreciation for motor vehicle 800, 750, and 12,000. Okay, for fixtures and fitting and machinery. Okay. Statement of financial position. All right. For statement of financial position, if you refer to the format, okay, if you refer to the textbook, for example, page if I'm not mistaken, page 89, okay, for statement of financial position. So if you refer to the textbook, okay, you may notice that, okay, I may not highlighted this, or I may not emphasize, okay, on this matter previously, but okay, starting from this topic, then you have to show, okay, for non-current asset, you have to show them clearly. For non-current asset, okay, you have to have this title, this heading, okay, cost, accumulated depreciation, and carrying value. And this heading is only for non-current asset. It won't affect your current asset, your owner's equity, your non-current liability, or current liability. Okay, so these three items here, okay, are for non-current asset only. Okay, all right. So that's why when I write cost, accumulated depreciation, carrying value, I put them in the same row as per non-current asset. Okay, then after that, okay, you're going to list down all tangible item first. Okay, followed by if you have any intangible asset, and finally you are going to end your non-current asset with the investment, if any. Okay, so before this, I may not highlight, all right, on the matter when you mix up everything between the investment, intangible asset, or tangible item. Okay, they are everywhere. Okay, but that's okay as long as they are still listed under non-current asset. Okay, then I am more than happy if you are able to do that. But starting from now, okay, you have to make sure that, okay, you are going to start, when you disclose non-current asset in your account, you have to start with tangible asset, followed by intangible asset, and finally investment. All right, only after that then you show your current asset, okay, and you continue until the end of your statement. Okay, so we have here motor vehicle, fixtures and fitting, machinery. Okay, write the cost, okay, of this asset, okay, and its accumulated depreciation. So you can see that now the amount of accumulated depreciation is increased, okay, compared to the their opening balances at the beginning of the year. Okay, because you have to add with the amount of depreciation that you have recognized or provided for that year. Okay, all right, so for fixtures and fitting now increase to 8150, machinery increased to 44,000. And the carrying value, so how do we calculate the carrying value? Cost minus accumulated depreciation. So if I put cost as A, okay, accumulated depreciation as B, so carrying value is A minus B. Okay, A minus B, that is your carrying value. All right, so that's all for depreciation. And in the following video, okay, I will discuss on the preparation of final account after adjustment. All right.